Just put it here.
As I was trying to say, Andrés is working for COBAS Asset Management. Of course, legendary value investor Parames has founded it. Andrés, if you would, we would be interested to hear your presentation. The clicker is on the screen.
Good morning, everyone. Well, thanks very much for having me here. I will just spend 1 second, and this is just to give you a snapshot of what we are today, which is not much changed from last year in terms of size. We are going up a little bit in number of investors, but we are still doing the same thing we were doing last year. And also just for 1 second to give you a very quick snapshot of our philosophy, what we do. Basically, we're looking for good balance sheets where there's potentially value just in the balance sheet itself, taking debt off of that, discounting it. Good businesses, which we can see will remain alive, for a number of years. Good management, because they are the guys that look after the balance sheet and the business, and if they're not good enough, they could destroy everything at a good price. So that's really simple. I guess everybody's trying to do the same thing. And within that, there's always a compromise. There will be something which is not right today, so that we can find, the good price. Perhaps, it's a temporary slowdown in the business or the cycle. So we're looking for temporary issues which don't break, the story really in the end. So, and also, sorry, just to go before we go forwards, if I can just have a quick raise of hands. About a topic which seems to be very, very visible these days, which is ESG. And I wonder how many here really care about ESG to the point that really precludes investment on things. So just a quick raise of hands. And also, if I can ask differently, I guess who among the people around already did ESG work before? So cared about the environment before, corporate governance before, and even social responsibility before ESG became such a popular topic. So I would have thought a lot of people already cared about this before. So for us, if I can say so, it's important, but I don't think we're doing things so much different from before. I find sometimes there's a bit of hypocrisy in the way people just check boxes and say this is ESG compliant, and then we go for it, or companies doing investments which aren't really accretive. And I think we can actually use ESG to our advantage, because I think change in ESG, improvement in ESG can be a source of profit. And with that, I wanted to talk about Golar, which is a company we've come across. And I think it's a dark horse for ESG. And ESG is just a tiny or a small portion of the case, but it's changing for the better. And I think it will widen the audience for the name. And the reason why it's a dark horse is because more or less 70% or more of the value of the company is coming from something which wasn't there before. And it's something very different from what they were doing before. So the value is coming from something else, and that is actually ESG accretive. It will massively improve the ESG perception for anyone. Even if they want to be hypocritical in the way they invest, they can use that. So we will benefit from that. So I will give you a quick introduction for the company. I will quickly touch on the LNG market globally, just to set the frame. Then I will stop in 4 key things which actually hurt the valuation of the company, which is our entry point, and why those 4 things, those catalysts will improve and help us crystallize the value. And lastly, I will tell you very quickly about how we value the thing and how much it's worth. And just to commence, this is an LNG value chain name, and they are pioneers in that. So they invented something called floating regasification many years ago, because it's a cheaper and more advantageous solution. Now they're inventing something else. And with those new things they're bringing, about 70% of the company's business is going to be locked in very long-term contracts, protected long-term contracts. That's a big change from what they were before. 23% is legacy LNG shipping, which is what people know Golar for, and that's actually quite small. It's going to be shrinking, and they're actually going to spin it off. So it will exit the picture, and it will not contaminate, if you want, the rating of the company and the perception of the company. Like I said, they're inventing something else called FLNG, which means floating LNG, and I will tell you a bit more about that. And I think another thing which is incredible about this company. I haven't really come across, a management team which is so conscious about creating optionality as Golar's management. That positive convexity, which I really love. They're always looking at ways to use the market to their advantage, to expand their circle of competence, downstream or upstream, so that they can create value and lock it in. So I think this is a great combination of value based on what we have today, plus the ESG and the optionality which they're creating by themselves into the future. So we can actually stick to what we have and hope to make money there, but also make more money if we want to stick around. Of the 3 blocks I mentioned before, the business, that's what I've just talked about. In terms of balance sheet, they have a bit of debt. That's all backed up by free cash and real assets. And that's actually been scaring some people off. So we will talk about that for a quick few seconds. And also in terms of management, very important 3rd block. These guys are really hands-on. The alma mater of the company, Mr. Torol of Troim, basically founded it in its new shape and form, and is really driving the whole thing forwards. And we think this is a great opportunity, and upside is pretty punchy, probably 160% if things evolve, not in a very aggressive way. So just to start on the LNG market, super quick. This is a chart which shows the evolution of primary energy sources for humankind for the last 300 years. And what I want to show here is that things, the combination, the mix changes. It used to be a lot of biomass, wood being burned, and animal power, which became coal, which then became oil, which is now becoming natural gas, which will eventually become more renewables. So this is no change. This has already happened many times in the past. We can also see that the use of energy has always been going up. And basically, that means that when an energy is replaced by the next energy, it doesn't necessarily go down. For example, there was twice as much wood being burned in the 19th century as it was in the 18th century, even though coal was taking over. So gas is coming, and that's not bad for everything else, but it's very good to have. So quickly also on some of the regulatory sort of noises and measures against emissions. Some people might agree or not with the science, with the measures, and with the policies, but as long as we have what we have, people want to reduce emissions, and the green line is what we should be doing if people were to deliver on those targets of less than 2% degrees warming, and the yellow is where we probably going to head with the current policies if they're implemented in full, and the blue is what happens if we don't do anything. And actually, to the right, that's the growth of energy users, and a lot of that comes from transport. So it's difficult to replace, but some of that can be replaced, or some changes can be done. But more energy is needed, and the mix has to change to comply with emissions. Natural gas is actually a very good transition energy, perhaps, or structural backload energy, because it reduces CO2, if a lot of people care about that, by 50% versus coal, 30% versus oil, but it also takes a lot of the rest of the emissions to zero. So energy is a good tool to get to those targets. Also, to the right is the CO2 emissions. Gas is the rightmost column, so again, shows the least emitting CO2, but it's also very cheap to the right. So that's the price of energy equivalent gas versus oil. It used to, or it should be about 16%, and it's actually been below 10% for quite a while already. So it's clean and it's cheap. And in terms of capex, so if you were to build a power plant, for example, you also have to consider not just the OPEX, which is the energy being burned or the gas being burned, but also the capex. Well, gas is also quite cheap. So the top, the rightmost column is combined cycle in the US, and somewhere in the middle, combined cycle in Europe. Again, gas is capex cheap. So clean, cheap OPEX, cheap capex. And to the right there's a lot of countries which have a very low use of gas at the moment. So there is a lot of scope to improve that. So why not use gas as baseload? That's different things which use energy globally. A lot of them can be converted into gas. A lot of transport, a lot of power for electricity generation, a lot of industrial power. And we come from a tiny base. This is the primary energy use globally expressed in barrels per day equivalent, and also the growth. So as you can see, the fastest growing is renewables. That's the yellow on the top. And the second fastest is LNG. Why is that? Because it's clean, because it's cheap. And LNG in particular, because you have to transport it from where it's been produced to where it's been used. So natural gas is really fast growing as well, but LNG is faster because the consumption is far from the production. So LNG has a future, it seems. It comes from a very low base of just 6.6 million barrels per day equivalent, which is tiny. So going into Golar, we came across Golar because we were doing work on shipping, and that's the original business for the company. But then we realized that's actually a tiny part of the story for Golar. And we were able to understand the future of the company because we are also close to LNG, energy and power, which are all the businesses we spend time on. And that's what Golar is going to play next. We came across lots of management teams out there in the industry really praising Golar's vision and Golar's management. And that was very encouraging. And then we saw Golar execute on the vision, little by little. A recent problem for some seems to have been liquidity and debt, but we are close to the company and we think there's no problem with that at all. And now we're getting to harvest time. This is the time where we can harvest. So let me show you Golar's share price here and also market cap, both, because sometimes, if you have shares being issued, share price can be cheap, but at the end of the day, market cap is what buys your business. Well, actually, there's not been dilution, and you can see it's been really high and then collapsed since 2014. And 2014 is when the vision started for Golar. So 4 issues and 4 catalysts. LNG shipping down cycle has been an issue. But like I said, it's become a smaller and smaller part of the business, and they're actually de-emphasizing it. They will actually spin it off probably before the end of this year. And that's public information, of course. They have a complex business structure with some debt concerns for people, and they're also working on that. Third issue, and actually tied up with the fourth, they have a very long lead time for those new projects which they're building up, which basically means that the transformation from, going to point 4, from an energy and oil perceived company into something else is taking time, and the market hasn't really liked those two kind of cyclical businesses recently, but as they transform, as we harvest after all those years waiting, the company will be very, very, very different. So onto the LNG shipping cycle. This is Golar in white, and the rest are also LNG shipping companies. As you can see, they've been basically driven by the cycle, up and down, no difference. Golar, like if it was the old Golar of shipping, and no difference with the others. And just to show you here a bit of a context. In 2014, John Fredrickson, a very well-known shipping tycoon, exited Golar because he didn't want to perhaps participate in the new vision and the new kind of company. He's more of a cycle asset allocator. Mr. Torolov Troim actually had a vision, and he wanted to implement the vision. So Mr. Fredrickson exited, incredible timing, and then we entered. Not so good timing. We're still trying to work on that. But what I can say there is we entered towards the end of 2017 with a small position and started building up because we saw that part of the business, Golar's business, the shipping, was actually improving. These are the rates for LNG shipping. You can see a very good market in 2011-12, then a very bad market, cycle, and then an improving market towards the end of 2017. Again, end of 2018, and we are seeing again the confirmation of that. It's a cyclicality or seasonality into that, but there is a structural strength because the cycle is driven by deliveries. As you can see there, in 2011 and 12, there were very low deliveries of ships. That created a very good environment for rates. Then we started to get a lot of deliveries, which hurt the market over 2013, 14, 15. And now we're still getting a lot of deliveries, but that doesn't really matter now because there is a huge wave of new LNG supply hitting the market. And it will continue to be hitting for the next few years. Only this year, we had 69 million tons of LNG being FID'd globally. That's about 20% of global capacity of LNG. And it keeps being FID'd because gas is cheap, it's clean, and people want it. So the red line is the growth in LNG supply, which is growing very fast. From 2018 is more or less grown at about 27%. But the green is the growth in distance times volume. They call it a cubic meter mile, which is growing faster, of course, because it's growing. Gas is growing in the US supply, and it's been demanded in China, for example. So the distance traveled is 3 times the distance. Basically means that we need more ships. We know more or less how many ships we need for every ton produced, which is 1.5. And we know how many tons are coming, and we know how many ships are on order in the order book, and we know there's not enough. So that's why we know the market is going to be tight in 2020 and 21, potentially weakening in 22, and we'll see what happens thereafter. But if FIDs keep coming, I think we're in for a very good shipping cycle, which, may I stress, is a small part of Golar's story going forward. This takes us into issue number 2, complexity of the business. This is what they are, very complex. They have an MLP, which is a tax-efficient vehicle in the US, which owns back half of a unit. Then we have the LNG carriers, which people don't like because they're cyclical. Then they have a lot of the other things they're inventing. And what they're going to do next is this. And this is public information. They're going to spin off the LNG carriers. That will take away the cyclical, disliked kind of business, which we think is worth money anyway. And that will help us have a cleaner structure with the MLP, which is a tax-efficient structure, potentially being unwound at some point because those MLP structures don't work anymore. We are seeing a lot of the MLPs being wound down by a lot of companies. We will have the FLNG, which I will talk about in a second, as a separate, potentially separate part of the business. And we will have a Golar Power, which is another very interesting part of the business, where they have a JV with Stonepeak, an infrastructure fund, and there is an option for Stonepeak to list it. Perhaps that will happen in 2020. Anyway, this takes us to a very much more simple structure going forward. So LNG cycle, not a problem anymore. Structure, not a problem anymore. Issue number 4, as I said before, is the long lead time of projects, which basically has meant people get tired of waiting, and also, the company doesn't transform itself into a new animal. This started in 2014 when Fredrickson left. Very shortly after, they ordered a unit, an FLNG unit, which stands for floating liquefaction. And then they got the FID, and a speculative unit became a firm order. And then they got another FID, which was cancelled. But very importantly, the first unit started to work in 2018, and he's been working on flawlessly. And second, they got an order from BP. And BP gives you the rubber stamp for quality and safety. Still, share price flat, like if nothing had changed. So what's FLNG? That's floating LNG. Like I said, they invented floating regasification. Floating LNG is basically a lot cheaper than all the other solutions to liquefy. Green bars down there, by quite a margin, by the way. But it's also good because it allows you to go after gas finds which are not as huge. So you don't have to have a multi-trillion cubic feet find. You can have a much smaller find there. You can also, so number 3, you can also go for more remote assets, gas assets. You don't have to have a lot of the infrastructure around. And number 4, very important as well, you can move it. So your counterparty risk, if your counterparty stops paying, it's a lot less. You can just take the unit and walk away and float it away. But it's basically an engineering piece of kit. It's not a ship. So those 4 reasons, I think, are very compelling. And if you look at the bridge for cost of gas delivered, this can actually be a lot cheaper than even the US gas, because you can find stranded gas assets which can be almost for free. You liquefy it more cheaply because the capex for the unit is lower, which basically means you can deliver the gas more cheaply. Cheaper than the US. That's in dollars per barrel equivalent, about 28 for this gas, perhaps 45 for US, and still, more than half or less than half the cost of diesel. So it allows to supply energy in a very cheap way. Of course, if you do quick numbers, they are the inventors at the moment, and they have a tech lead of about 5 years at least, which makes us comfortable to believe that those returns you can get on that capex, which is 1.3 billion. These are the numbers for the BP unit. In theory, a lower return unit because it's a very good counterparty, right? But it gives you a 1.3 billion capex, which you can lever up, and which gives you 20 years locked-in contract, guaranteed EBITDA. Well, that's a 16% IRR at least on your asset and 33% on your equity. The beauty of this is because they have a tech lead, they can reinvest that in the next unit. So we have massive compounding available here. Going back to what makes a good disruptor, they have the technology, we have the efficiency, and we have the market out there. Also, to give you a data point, back in 1985, there was only one FPSO, floating oil producing unit. And then that's the go-to solution these days. Well, we're talking about the beginning of the liquefaction solution, which is disruptive, and perhaps we'll have a lot of units in the future. We're just thinking these guys could be good for 5 years, and we will see what happens. Who else could compete? Well, perhaps Technip could compete, massive company with great engineering capabilities. Perhaps SBM Offshore, they build FPSOs. They've told us not within the next 5 years. There's another company actually called Exmar. They are also pioneers in FLNG, and they have one working unit, but they are a much smaller company with a lot less access to financing. So this seems like a very promising place to be, and a great new business, locked in 25 years contract. The other area where Golar is actually creating a lot of value is the LNG and power, the integrated power solution. So LNG sold their shipping business, and they thought this is not strong enough, it's too commodity. They moved on to floating regasification, and they also thought that's too commodity, and created floating LNG with their leading. But they say, well, what can we do with our floating regasification? Why don't we just integrate it with power and use our own units to that power and build great value through that? And that's exactly what they're doing. Again, the timeline, back in 2016, I think that is. 17, actually, they signed they created the JV with Stonepeak, and then we are going to have the first integrated power project start generating free cash on the 1st of January 2020. So we're getting very close to that harvest. It's 98% complete construction-wise. Again, well, these are great projects if you can get in them with good returns. So these are very good return projects for them at the moment. They tie up the construction of a plant, which is the largest thermoelectric plant in Latin America, with one of the units, which gives them great returns for that unit, which otherwise could have been competing in the open market. But the great thing about this, and like I said, I've never seen a company which creates so much optionality, is they use this as an anchor to create extra value around that. So the capacity of the regasification will only be 1/3 utilized. 2/3 will be available for them to use. And they can use that to arbitrage the power market or arbitrage the gas market. So gas to wire optionality. Well, that's how cheap can be their power generated with gas, about $50 per megawatt. And they can sell it a lot higher when that's available. They just get paid for the capacity. If the plant is not running, they just get paid anyway, 25 years locked in. And then if they want to produce power because it's good to arbitrage, they do, and they make extra money. But what about gas to wheel? So they can deliver energy to a truck at about 50% of the cost of the current diesel cost in Brazil. So just to give you a number, they have 160, assuming they use 1/3 of the capacity for the power, and they only can use 2/3 of that for something else, it's 160 million MMBTU. If they make $1 arbitrage on that, it's $160 million EBITDA extra, which at the moment they basically have the option to do. And we're just talking about first plant, Sergipe. A couple of weeks ago, they signed the second project called Barcarena, which will be smaller power and perhaps give them a lot more excess gas to use for something else. Just putting it all together, since 2014, all these guys have done and where the share price has gone hasn't actually reflected at all what they've done. They've built, they've delivered, and they're generating cash flow. And we're moving into the next phase of cash flow. They built 6.6 billion backlog for revenues since 2014. Share price hasn't reflected any of that. And free cash flow is going to start trickling in. Actually, it's already trickling in after their first FLNG unit came online last year. Now we will have potentially a third train for that unit, and then we'll have Sergipe power, and so on and so forth. So this is harvest time for Golar. And we're talking about long-term contracts. So this has a different kind of value, right? But there are risks, of course. First, what happens if their first unit, which is working at the moment, Hilli FLNG, has an issue? I mean, it's been working with 100% uptime. Of course, if it has an issue, it will have to be stopped. The risk is that perhaps people question the optionality of extra FLNG units over the next 5 years. Perhaps BP delay their unit, which they signed on last year. I don't know, something can happen to that unit. They will fix it, they will keep it working, but I mean, that's something to keep in mind. So far, we get a lot of comfort from their execution, of course. Second risk, what if there is no such thing as a tech barrier anymore for them? Actually, they're integrators of tech. They take tech from Black & Veatch for the modules, they talk to the yard, they connect them together. They do a lot of the engineering work themselves, which saves them a lot of money. So for somebody to do this in a yard would cost them about 700 million extra to what they pay. But that is a risk. So far, we have done a lot of checking. Only SBM offshore, perhaps Technip, and Exmar, like I said before, could try. But Exmar could do straight away. But the other two, at least 5 years out, if not more. And we're talking about a market which could be large, like FPSOs were, from 1 to several hundreds. Third risk is the shipping cycle. Like I said, they're spinning it off. That's to emphasize, and that's a small part of the value. And lastly is debt liquidity. And this debt is backed by real assets. So, it's not just sitting around for the corporate. Each of these assets can be levered up because you have a 20-year contracted revenue stream, right? So those back that debt. So we have the cash flow flowing in, and they have quite little equity capex left to do. So I don't think that really is a risk at all. But I just pointed out because the market has been concerned. One fifth risk, which I may point out, is, of course, if we have massive inflation and high rates, the EBITDA is a fixed amount. So that would be worth a lot less in today's money. But in terms of valuation, and I apologize, this seems quite small. But may I say, the FLNGs, the current FLNG units are worth about $18 per share. Then we have to say that Golar Power asset should be worth about $9 per share. And that's taking the EBITDA times a multiple, which we say arbitrarily 12, for example. You can pick your own. But that is backed up by our DCF, more detailed DCF, so that makes a lot of sense. Less the capex and the debt, right? So 18 or 19 for the FLNGs, 9 or 8 for the Golar Power. Then we have the LNG shipping business, which is 3. As I said, very small value in the company, but the company is still perceived to be shipping. It's not shipping. It's long-term contracts, clean energy, ESG friendly, right? And that should make people think twice when they look at this, when they simplify things a bit more. And the MLP, which is a listed vehicle, and is worth 2. So that's a total of at least $28 per share with what they have today. And that's 90% upside. That's today's value. Then we have tomorrow's growth if we want to add that on top. And we can sort of think about, perhaps one FLNG unit extra. They're discussing with a lot of people out there. It's a very cheap solution and it's working, and BP gave them the quality stamp. And perhaps what about if they can extract some value from those 160 million MMBTU free in the current Golar Power solution? What about $1 per MMBTU there, 160 million? So that would give us, another $15, and it takes us up to 45. But we think, we go for somewhere in the middle, 38, which is 160% upside. If I can compare this just super quick with two peers, Cheniere, they build liquefaction plants and they charge a tolling fee like Golar do with the FLNG. They trade at 9 to 10 times on the mother company and 12 on the MLP, and they have a lot of leverage on. So just to make sure that people understand in the market out there that leverage for good assets can make sense. Our leverage here is a lot lower. It's 5. Okay. So that's a reference, multiple and debt. And what about New Fortress Energy, which we find very interesting? This is a new company from a couple of years ago. And what these guys do is exactly what Golar Power do. They look for a power plant, which they don't own, but we own our own, right? So they don't own the power plant. They supply gas to the power plant, and they hope to have excess capacity to sell to trucks and other industrial uses, small LNG, they call that. Well, Fortress Energy's got a market cap of $3 billion, and they almost don't produce any EBITDA yet. So I think, if we look at the bottom table there, like I said, Golar Power own a 1.5 gigawatt plant. They will make about $80 million on the power plant itself, plus the regasification extra, which is another. Sorry, this is for Golar alone, right? But they will make another 20 million for Golar alone. That's 100 million, and then we have 160 million MMBTU free to make perhaps $1 on that. That's another 160 or 80 to Golar. New Fortress Energy gets a 3 billion market cap, and they expect to make $4.4 per MMBTU, 4 times what we could potentially say makes sense for Golar 1 versus 4.4. That's how New Fortress Energy gets this valuation. Of course, if we did that, we would get a massive uplift to valuation. We could say that perhaps Golar Power alone should be worth 2.3 billion, of which half would be Golar's, right? So that's today's market cap. So that's the optionality. That's what Golar are doing, building around what they have, extra optionality, and moving away from businesses which are commodity and which are disrupted. I'll leave you with this value chain snapshot of Golar to show you where they are. They're basically everywhere, and they just pick and choose the best spots. A little bit on, and less every day in shipping, growing into liquefaction, and growing into downstream. With that, I'll leave you if you want to make any questions. Thank you very much.
So are there any burning questions? Because I don't want to chew too much into your lunchtime. We still have one presentation left, so. With that, I would like to think. Yes. Oh, we have one? Oh, sorry.
I was just, how many clients does Golar have downstream? You mentioned they are also active downstream, but what does that mean? So that's just a silly question, but.
So the downstream, they're still creating it. They have the power plant, which underpins that with 100 million free cash to them, and 160 million MMBTU free to do whatever they want to do with that. So they just hired a couple of guys in Brazil, and they're laying out and the business for the next couple of years. They say they can invest about 50 million at most. They wouldn't need to invest a lot more than that, and then get all the return back within a year or even 2 years.
But they would then start producing electricity. Is that it?
No. So that's already up and that will be up and running from January.
Okay.
And of that, if they produce electricity or if they don't, they get paid anyway.
Okay.
Yeah? And then around that, they will create the small LNG sort of market, trucking, industrial, you name it. Everything which where people think they want to pay, half the price of diesel, they will do. Okay. And perhaps keep $1 per MMBTU out of the 14, which is a margin.
Okay, thanks.
Okay, so Andrés, thank you very much.
Thank you.